Hello guys, I hope you will be fine. So today we are going to discuss about the cost and variance analysis. As we know, the variance mean to say the difference or the deviations. So variance analysis we can use to assess the performance of the company. We can also use the variance analysis to assess the performance of the departmental manager. Let's begin with the definition of the variance analysis. So actually the variance is the difference between amount budgeted and amounts actually incurred. So to understand these two key words, so what we need to do, we need to understand first two types of the budget. So first type of the budget is called static budget, and second type of the budget is called flexible budget. So static budget is what? Static budget actually it is also called a master budget. It is also called original budget, and the strategic budget we prepare at the start of the budget period, and we also prepare at a single activity level. And if you prepare at the start, so of course it should be based upon the budgeted data. So we will take here budgeted output level, and we will also multiply with the budgeted cost, and budgeted cost is also called a standard cost. But on the other hand, we have a second type of budget which is called flexible budget. Flexible budget just we can prepare at the end of the budget period when we will get the actual results. So that is why, so what we need to do here, we will take actual output level multiply by with the budgeted cost. On the other hand, we have another word which is called amounts actually incurred. So this is also called actual results. And for the actual results, what we need to do, we need actual output level, and we will multiply with the actual cost or the actual sale price per unit. To understand the concept, now we need to look at the example, and we will solve the example to understand the concept of static budget, flexible budget, and actual results. Let's assume we have a company, and this is the standard cost per unit for that company. Standard cost mean to say it's an estimated cost under predefined working condition. For example, if you are manufacturing table, so maybe you have a past experience, and due to the past experience you can also estimate the cost of one table for the upcoming period also. And this is the data. For example, we need a cost of material, we need a labor cost, we need a variable overhead cost, we need a fixed overhead cost. So for one table, maybe we need 5 kg of material, and we are paying $10 for each kg of the material. So it means we need $50 for the cost of the material. And we also have a labor cost here. We need a 3 labor hours to produce one table, and we are paying $15 for each hour. So 3 hours times $15. So we have a labor cost of $45. And we have a third component which is variable overhead, and I'm assuming here variable overhead are based upon labor hours. So here we will use 3 labor hours multiplied by $6 per labor hour. This is the rate for variable overhead. So 3 times $66, so you will get $18. So then we have a fixed overhead. So I'm assuming here maybe fixed overhead for the 1 year it is $10,000, and we are planning to produce 1,000 units in upcoming period. So what we will do here, we will take $10,000, a $10,000 divided by 1,000 units. So you will get $10 per unit. So if you will make the summation of cost of material plus cost of labor plus variable overhead plus fixed overhead, so we will get the product cost, which is $123. We are also provided with the data of the budgeted sales price per unit. So budgeted sales price per unit is $200, and we have a budgeted units which we are planning to produce in the upcoming period, that is 1,000 units. So company actually sold 900 units in that particular period. Now the question is that how we can prepare the static budget and flexible budget, or how we will get the actual result. So let's start with the static budget first. If you remember, I told you in static budget you will use everything budgeted, like you will take the budgeted output and you will multiply with the budgeted cost, which is also called standard cost. So let's start now. So we have a budgeted sales of how much? 1000 units. We will write it here. So static budget at 1000 units. So first we need to write here sales value. So what we will do, we will take this 1000 units, multiply by the budgeted sales price, and budgeted sale price is $200 per unit. It is given here. So 1000 times 200, you will get $200,000. Now we need to subtract here cost, all the cost. So here we have our cost of material first. So what we will do, we will take this budgeted units, multiply with the this standard cost data of the material. So what we are going to do here, so we will take 1000 units, multiply by 5 kg from standard cost data, multiply by $10 per kg from the standard cost data. So this will give you total cost of material $50,000. So then same way what we need to do, we will calculate the labor cost as well. So we have a 1000 budgeted units, multiply by 3 labor hours, which are standard hours, multiply by $15 per labor hour is the rate. So we will get 45,000. Now we have a third cost, which is variable overhead. So same way we will apply the concept. We have a 1000 units, which are budgeted units, multiply by 3 hours, which we will take from the standard cost data, multiply by $6 per hour. This we will also get from the standard cost data. So we will get here $18,000 for variable overhead cost. And now we need to write here fixed overhead, and fixed overhead we will take it from the standard cost data. As you can see here, fixed overhead total was $10,000. So this $10,000 we will write it here. Now what we will do, so we need to subtract all these costs from the sales value. So this is how you will get the amount of profit or loss, and which is $77,000. Now we need to understand the flexible budget. If you remember, I told you for the flexible budget, like we will use actual output multiply by standard cost, and the standard cost is also called the budgeted cost. So actually company sold 900 unit, which is given in the example. So this is what we are going to do here. Flexible budget at 900 units will be as follow. So we need to write first of all sale. We will take actual output multiply by budgeted sale price. So actual output is 900 units, budgeted sale price is $200. So if you will multiply, you will get $180,000. Now we will subtract here less all the cost. We have a cost of material. This is how you will do. We will take 900 units, which are actual units, multiply by 5 kg, which is the standard data you can see here, multiply by $10 for each kg. This is also standard data. If you will multiply, you will get cost of material of $45,000. Now we also need to subtract cost of labor. We will take actual units, which are 900, multiply by standard cost data, which is 3 hours times $15. If you will multiply, you will get cost of labor of $40,500. Now we same calculation we will do with the variable overhead. We have a actual units 900, multiply by 3 hours times $6. This is the standard cost data. So this will give you variable overhead cost of $16,200. Now this is really important, fixed cost. As we assume fixed cost will not change with the level of activity. So whatever we have written under the static budget, which was $10,000, same value we will write here as a $10,000 here. So we will not change. Okay, so this is really important. So what we assume here, we assume the fixed cost will not change with the level of activity. Now what you will do here, so we need to take sales value less all the cost of the production. So you will get the amount of profit or loss, which is 68,300. I'm assuming here. So now guys, we have another column here. You can see this column is for the actual results. For example, I'm assuming because actually we sold 900 units, and this is the data for 900 units. This is the actual sales value 210,000. We have an actual cost of material of $60,000. We also have an actual labor cost of $40,000. We have an actual cost for the variable overhead is 20,000. you have an actual cost for the fixed overhead is 15,000. Here you are writing actual fixed cost, okay? But under the static or flexible budget, it will be the same value. Don't forget this point. Now we need to understand the definition. As I told you, if you will look at the start, I told you the variance is the difference between amount budgeted and amounts actually incurred. So this is not the complete definition. Now I'm going to tell you the complete definition because it depends in your exam. It depends upon your exam which kind of variance examiner is asking you to produce. So this is really important. So now we can see here we have a two types of budget, static and flexible. Do we need to compare actual results with the static, or do we need to compare the actual with the flexible? So it depends upon the requirements in the question. So actually we have a two definition now. So first one is called static variance. Static variance is the difference between static budget and actual results. If you will look at the example, if I will compare static budget with the actual results, this will give me static variance. And now you should keep the difference. What is the difference between static budget and actual results? Now if examiner is asking you to calculate the flexible variance, so flexible variance is the difference between flexible budget and actual results. If you will look at the example, so here we have actual results. If this actual results we will compare with the flexible budget, this will give us flexible budget variance. So this is really important. If you will look at this example, so in this example we have a data related to sales which is called revenue side variance, and we have a data related to the cost which is called cost side variance. Now these words are really important. So on the revenue side you might have a favorable variance or you might have an unfavorable variance. For the revenue side, when the variance could be the favorable, the favorable variance occurs when actual revenues exceed budgeted revenues. So on the other hand, unfavorable variance occurs when actual revenues are less than budgeted revenues. Now we have a cost side. For the cost side variances, again you have a two types. You might have a favorable variances, you might have a unfavorable variances. So for the cost side, favorable variance occurs when actual costs are less than budgeted cost, and unfavorable variance occurs when actual cost exceed budgeted cost. How we can come to know either this variance is favorable or unfavorable? Actually it depends. Like if the variance has a positive effect over the income, we would say it is favorable. If the variance is having a negative effect on the income, on the net income, so we would say it is unfavorable. For example, favorable variance always increases the profit and unfavorable always decreases the profit. Now we can see here the purpose of variance. I hope it will be clear more now. So purpose of variance is to use the knowledge about variance to promote learning and continuous improvements in the manufacturing process. Because if the variances are favorable, you can also reward the managers. If the variances are unfavorable, maybe you can ask the manager what are the reasons for this unfavorable variance. Sometimes reasons are controllable, sometimes reasons might be uncontrollable. I can just give you example. For example, if the variance for the material cost is unfavorable, okay, so maybe we can't blame the procurement manager. I'm just giving you example. Because maybe there is inflation in the economy, and when at the time when we prepared the budget, at that time there was no inflation, but suddenly there has increase in the prices of the material. So that is why we should not use the variance analysis only to blame the manager. Sometime variance could arise due to their negligence, or sometime they might not be responsible for that specific variances. Maybe it is not under their control. Now we are going to apply the concept whatever we have learned. Now we will apply through the example. For example, we have a company, a manufacturing firm, planned to manufacture and sells 100,000 units of the product during the year at a variable cost per unit of dollar 4. For the variable cost per unit, it remains constant, we assume, and the fixed cost per unit is $2. So fixed cost per unit, it might change, because if your output will go up, fixed cost per unit will go down. If your output will go down, fixed cost per unit will go up. The firm fell short of its goal and only manufactured 80,000 units. Even we were planning to produce 100,000, but we actually produced only 80,000 units at a total incurred cost of $515,000. This is the total cost. Total cost, and for it includes the cost of it includes variable cost plus fixed cost. The firm's manufacturing cost variance was in the requirement. They're asking you to calculate the variance. If question is silent, we will assume it is the flexible variance. So, and there are four options. Either the manufacturing cost variance was 85,000 favorable, or 35,000 unfavorable, or 5,000 favorable, or 5,000 unfavorable. So now we need to learn with the help of example. Let's move to the solution now. So this is the data which is provided in the question. We are provided with the budgeted output, which is 100,000. We are provided with the budgeted variable cost, which is $4. We are provided with the budgeted fixed cost, which is $2. And we are also provided with the actual information. We have actual output is 80,000 units. We have an actual total cost of 515,000, and this includes variable plus fixed cost. Now you have to calculate the manufacturing cost variance. It means we will compare total cost with the total cost. So here we have an actual total cost of 515,000, which is given in the question. And now you need to calculate the flexible cost, because actual cost we will compare with the flexible cost. And flexible cost has two components. First is the variable cost, and flexible budget or cost we always prepare at actual activity level, and actual activity level was 80,000 units times $4. So you will get variable cost. And as I told you above, okay, or before, I told you the fixed cost will never change under the flexible budget. It means whatever the fixed cost was under static budget, same value you will write it here. But for the static budget, how you can calculate? So you are provided with the fixed cost per unit 2, and you are provided with the budgeted output. If you will multiply budgeted output with the budgeted fixed cost per unit, so you will automatically get the fixed cost as per static budget. So this will be $200,000. So now this is your total flexible cost, $320,000 plus $200,000. So you will get $520,000. Now this flexible cost you will compare with the actual cost, and you can see actual costs are less than flexible cost. It means this variance should be favorable. Why? Because this will increase your profit by 5,000. Let's apply the concept with another example. We have another company, ABC company here. ABC company uses flexible budgeting for the cost control. Actual unit produced in the month of April are 10,800 units. So these are the actual units, don't forget. And we have a actual material cost of $13,000, and this is the actual cost of material. Its master budget, mean to say static budget, for the year reflected material cost of $80,000. This is under the static budget, and the production level of 144,000 units. So this is also as per static budget. The flexible budget for April production would reflect material cost, like they're asking you to calculate cost of material but as per flexible budget. So we have here four options. Let's have a look how we can do it through the help of solution. Here we have a solution. Now as we know the flexible budget material cost, how you will calculate, you need actual output multiply by budgeted material cost, and actual output is given in the question as 10,800 units, which is available here, right? We will multiply with the budgeted material cost. Budgeted material cost and for standard cost as per static budget, and the information is available there. So he told you total budgeted cost of material $180,000, and he told you total static units, or budgeted units was 144,000 units. If you will take $180,000 divided by 144,000 units, so automatically you will get $1.25 per unit budgeted material cost. So this cost you will multiply with the actual output, so you will get the material cost as per flexible budget, so which is 13,500. It means option A is correct. Now we are going to discuss question number 3. Here we have a XYZ company planned to sell 100 units for the month of July at an average sale price of 600. So it means it's a planned data, means say you can say it's a budgeted data. So midway through the month, company had sold 65 units, means during the month we sold 65 in the midway. Yeah? At the forecasted total sale of 130 units, this is a budget, like we are making prediction maybe in the mid of the month, or we will sell 130 units at a price of 680. This is not relevant because it's a midway through the month. We need static budget. This was the static budget information, and we need to compare with the actual results. So here we have our actual sales for July were 120 units. This is the actual sale, and average sale price was 590. This is the actual sale price. What is the flexible budget amount for this sales revenue for July? So you have to calculate amount of revenue for the July as per flexible budget. So we have a 4 option. Let's have a look how we can do through the help of solution. So this here is the solution. So flexible budget sales revenue you have to calculate, and we know it is equal to actual units sold times budgeted sale price. Actual units sold are 120 units, which is given into the question. We just need to multiply with the budgeted sales price from the static budget, and budgeted sale price was 600 unit, which is available at the start of the question. So what we will get 120 times 600 dollars, so you will get dollar 7,000 72,000. I hope it is clear. Now in the upcoming videos, guys, what I will do, I will upload the videos for the variances for material cost, labor cost, variable overhead cost, and fixed overhead cost, and I will upload the video at basic level calculation and for advanced level as well. If you really like my video, uh, don't forget to subscribe to my channel. If you have any question, you can ask through the comment section. Thank you so much, guys. See you next time. Bye bye.